Steve is with HIS Capital. This is Dennis Blitz. I'm with the IRA Club. Thank you for coming.
Well, thank you so much, Dennis, and thank you to everyone that joined this call. In this model, I'm going to show you you're 100% passive, and someone else is going to do the heavy lifting and protect us. While you're looking at this, I'll tell you a little bit of my story, my background. I was in business for many years, and I'm 57 years old today. So 7 years ago, I had the opportunity to walk away from my career being in the insurance industry. And my goal was at 30 to be debt free, and my goal at 40 was to have a net worth of $1 million. And my goal at 50 was to be retired. And all of them have been achieved, but at 50, the company actually paid me to leave. And it was through a merger and restructuring, and I was happy to move on. What I found were two things. One was retirement was pretty boring. I thought it was going to be a while, all my problems were done. And I love to fish, but I live on a lake, but I don't like to fish that much. And I realized that I'm watching my neighbors leave for work, and it's like, I just want to go with you. Wherever you're going, you've got a purpose today. And I remember thinking work is a blessing. And so I understand real estate, been in it since I've been 18 years old, bought my first property. My wife and I built a portfolio of them. And so I get that. And then, but someone said, they said, Steve, why do you want to buy all these rentals now in your 50s and deal with tenants? And I said, I don't want to, but I don't know what else to do. And it was then someone said, Steve, why don't you become the passive real estate investor? And honestly, that's the first I ever heard of that. And so I became a student of it. My wife became a student of it. It led us to his capital group. And what they told us, they said that we can get you a predictable monthly return. And back then it was at 8%. And I can get a monthly check with an annual 8% annualized interest rate. I can actually calculate my monthly payment, and to pay my bills, it's just like a pension. I'm retired. And so I ended up buying a whole note from them. And sure enough, it came out right to the penny. And so I started to learn this industry. They hired me. And I've been with them for like 7 years now. So I'm blessed to be back to work, blessed to be working, but now I can work. I don't have to. But the model of his capital funding is actually, we watch the real estate cycles. And the real estate cycles, we say there isn't a bad place in the cycle. It's only bad if you're not prepared for it. And in fact, we say the cycle doesn't tell us when to buy it, or how to buy it, tells us when to buy. But when it comes to a real estate cycle, we've got an economist on staff that actually predicted the crash in 2008. He's not good enough to predict COVID, but he did predict that we are going to have a down market. And we don't know when, but we know it will happen. So what we've done is we've actually built a Reg A fund to take us through this market and down the saturation stage to the decline and get to the absorption. And a lot of millionaires are made in this area. If you're prepared and you've got cash, it's not a bad place to be. And then you ride it up, and then obviously you sell at a high. The $1 million question is, how do you stay cash rich down here waiting for it, but yet you want to invest in real estate up here without tying your capital up, and to stay liquid here? And we'll talk about that, and we'll talk about our model that takes us there. A little background of the company: we've been in and out of about $500 million of real estate investments overall. We put a little fictitious city together in our office, but it's all properties that we've invested in, we've been a part of. And the strategy that we use at his capital funding is, for our capital, and we recommend you highly consider it, and you all know that you don't put 100% of your investments into one vehicle. We do it in what we call as a 40-40-20 strategy. 40% is in residential and commercial appreciation, quick pops, flips. We buy low, we sell high, we make fast money in that area. 40% in the middle, that's our oxygen, that's our cash flow. That keeps us going. That keeps us going through 2008. That keeps us going through COVID. We do that with our rental portfolios. We collect monthly rent checks, and we do it through notes. And notes are what we're going to be talking about today, and we're going to be talking about each strategy and how you can be a part of them if you so desire. 20% of our income or our capital comes from high risk, high reward. And so we reserve 20% of our capital for the whales. You never go chasing a whale, but being a private lender, sometimes these deals fall in our lap where the general public may never see them. On this figure 8, this is an engine, and this is really our engine. And this engine just keeps running day and night. In the middle of the engine is the money, his capital funding. And we lend to active investors that come to us and they find a deal. They might find a deal that say, hey, I found it for $100,000. I'm excited. It's worth 300 and only got to stick 75 into it. Well, we're excited for them as well, but we're going to vet the borrower. If they pass that, we're going to look at that deal. And if that deal looks good, we're going to move it on to from processing to underwriting within our own office. Our goal is that every applicant and every deal gets all the way through so that we can fund them ultimately. That's where we make money, okay? In reality, many of them never make it this far. And you would think that the applicant would be upset with us at this point, but actually that's a key player in our investment strategy. That borrower, that active investor, they usually thank us because they come to us for 2 reasons. 1, obviously, is the capital. They want to leverage our capital. 2 is they want another set of eyes on that deal. And if we find something that would have ate their lunch, they're pretty thankful that we caught it. And then they bring another one back. But ultimately, the ones that do make it through, we all get to make money on. And so then we fund, and let's call it, for this example, a 10% interest-only bridge loan of 12 months. And again, the only people we lend to, it has to be an entity. It's only a business purpose loan. And so we're not lending to an individual. So once we lend to them, we then bring in a third-party servicer called FCI, and they do our heavy lifting. So they collect the monthly payments, they pay his capital. In a perfect world, we sit back and we just collect our monthly payments, which each one of you are on this call for, and that's your goal, I imagine. Okay, that is the banking world. There's another world that opens up on the bottom of the figure 8. And that is called the passive investor. And many of you on this call are probably passive investors, but many of you might be active. And the beauty of this model is many of our active investors and passive investors are both. I'm both, okay? So it plays into not only your income for today, but it also plays into your wealth for tomorrow, where your money starts making money. So the passive investor comes to us and they say, you know what, I would love to be in that position. His capital lent, they did all the vetting, they did all the work, they've got a good loan to value, they're first position in public record, and they're sitting back just collecting the money. Well, they will sell that note to a passive investor like you. They'll sell it for 8%, keep 2% for doing all the work, okay? And that's called their arbitrage, their spread. Well, now FCI collects the 10%, let's call it, from the borrower, 2% goes to his capital. The lion's share goes to the passive investor, which would be you. And now your first position of public record, you took over. And now you sit back and now you're collecting the interest. All along, let's remember the first investor in the deal. Nothing happens without the borrower, and we love the borrower. They're usually the biggest winner per deal. They're coming in and they don't want to make anything less than 20%. They're going for the 30s and 40s. In fact, if they make less than double digits, we probably wouldn't lend to them. So they go to work and they stabilize this asset, and they either finance us out or they sell it and they flip it. But at that point, they pay off you, the passive investor, or me. I'm one of these. And so now we've got 3 happy investors. His capital, they've got what their model is designed to do. They got out of it. That active investor got to leverage our capital, got to use us for our systems, and they made what they wanted to make. And the passive investor, which would be like my wife and I here, we're happy making a predictable 8% and doing nothing at all. So when we get to this point, all 3 of us high five and we all do it again. There's different types of passive investors. One would be an individual, like we're just talking about. The other investor are huge hedge funds, large institutional investors that come to us with millions of dollars, and they'll buy these notes up. And one of our investors has purchased, I think it's even closer to 40 million today. But overall, we've got over 1,800 passive investors that take advantage of that model. So we know it works. I know it works as an investor. What I just showed you is what we call the whole note strategy. And out of the entire 40-40-20 strategy, we have been sharing that one strategy with passive investors. And we've been providing, we call it maybe a 6 to 8% return. And I mean that by some notes might pay 6%, some notes may pay 8%. And what we've done is we've added, earlier I mentioned, a Regulation A fund. And it's been a 1.5 years in the making. It's been grueling to get here, but it's a big deal, and it's a big deal for everyone on the call here. And the reason I say that is because we have funds. We have funds that are doing, we have a fund that's doing actually quite well. It's in the double digits right now. In fact, that's the model for this fund. But the challenge with that fund is the only investors inside there are accredited investors. They're all high net worth investors, and the average person can't even play in their game. With a Regulation A fund, all of us can play in the game. As long as you got $5,000, you know what? You'll probably qualify. So it literally opened up the net to all of us. The difference between the whole note and the fund isn't much. It looks very much the same. It's all driven by lending, very much like that figure 8 I showed you. The change is made where we brought the 40-40-20 down to all of us investors. So now instead of just being part of, let's say, that 8%, now we're not only part of the interest, but we're part of the equity of the projects themselves. You and I get the first 7% of all profits. So the first slice of the pie goes to you and I as investors. After that 7%, it doesn't cap like a whole note. We get the upside. So above that hurdle, once it gets above 7, we split 50-50 of all profits all the way out. So if we go back to kind of revisit the 40-40-20 strategy, now, you know what? The flips that we're doing inside the fund, we get our waterfall, the first 7 and then 50-50 split. We get not only the note portion of it that's driving this, the lending arm, but we're also being part of the rental incomes, which even means that we're owners of the assets inside the fund, which means if that asset appreciates, guess what else? We get a portion of that too as investors. And then we talked about the 20% high risk, high reward, and I'll show you some examples later, but we get to be part of that as well. So it's been a game changer for the average investor. The operating partner model looks like this. It's ARC fund management. Remember when I showed you the real estate cycle earlier? The ARC fund management, we named it ARC, like Noah's Ark. We wanted to be able to float over top of that down, and we wanted to be able to take advantage of everything we can when that market's down, and I mentioned earlier to be cash rich. The ARC fund management is an owner in the Regulation A Fund 3. The other owners in the fund are you and I as investors, the limited partners, the passive investors. And we have a fund administrator, which is a third party that reports quarterly to us investors, but also reports biannually to the SEC, as well as a third party auditor doing the books. Now, inside the fund, we're diversified, but it's all real estate, but different markets. So in other words, if we're all into residential and the residential market changes, you know what? It's okay. We got commercial, we got development, with lending being our main spear. And the little bit of the difference in the fund, the borrowers are going to look a little bit different. The borrowers are what we call as operating partners. Operating partners, we created an entity for people and individuals and companies that we've developed relationships with over the years that we trust and that have proven successful and that they're experts in their industry. They are now our borrower. We as a fund are now the lender, as was his capital in the figure 8. Okay, so now we lend as a fund to the borrower and we help them scale. Not only do we get a portion of the interest, but we get a portion of the profits per deal. So now you got not only the interest, but now you got an equity position. One question I had when I was a new investor, just think about this. If his capital funding, being the bank, can get 10%, why would they give 8% to you or me and give the lion's share of it away and only keep 2%? This model, we'll talk about that and why it does make sense. And it makes sense to me now. The other thing it'll show us is I mentioned earlier that $1 million question, how do you remain cash rich when the market goes down? All of us want our wallet full of money and we want to buy everything on sale. How do we do it and keep our money working at the same time in real estate? We'll talk about that in this model. The investment banking strategy, we're going to lend $1 million for an example for this model. We're going to sell it off for 8% to one of them hedge funds, one of those institutional buyers we showed you that'll buy millions from us. Okay, so we're going to keep the 2% arbitrage. Now think about this. The hedge fund writes us a check for $1 million. We got our $1 million back and we kept 2%. So let's say we stop right there. Over that year, we're going to have an annualized 2% and our $1 million is back in our pocket. But like I mentioned, that figure 8 just keeps going. It's a machine. So we're going to lend again the next month. So if we get to May and we lent it out 4 months, 4 times, okay, well, we have 2, 4, 6, 8. If we hold it for the year, we've already crossed that 7% pref that goes to the investor. So now is where the game starts. So the fund can't make a profit until that 7% is out of the way. So let's take this and let's just say we turn this capital 10 times in 1 year. So 10 times 2%, simple math, that's a 20% return on our investment. That's a $200,000 cash return. And where's our money? It's back in our pocket and we're ready for the next deal that comes along. Diversification, Basically what it does, it allows you and I to be in each market, wherever the strength is. It allows us to not take all the risk of one whole note. There might be hundreds of us inside there that own a note.
Thanks a lot.
Thank you, Dennis. We appreciate you guys.
The information contained herein is intended to help the viewer successfully navigate common IRS and Department of Labor requirements to help achieve successful results from their IRA. The information is not intended to replace information from your legal counsel or income tax professional. IRA Club does not offer or sell any investment. All investments have risk.